As the market is closed for the weekend, we are looking at the figures from the end of trading on Friday, November 7th, 2025. The Strive U.S. Energy ETF, ticker DRLL, finished the session at $28.89. This was a solid move up, gaining just over 1.5% or 43 cents on fairly moderate volume. The day saw it trade in a tight range between $28.49 and a high of $28.98, just shy of that $29 mark. Now, seeing an energy fund up on a given day is not by itself surprising. The entire sector has been a volatile but often rewarding place to be. The common expectation for an ETF like DRLL is that it's just another basket of energy stocks, a simple passive vehicle to get exposure to names like Exxon, Chevron, and ConocoPhillips. You buy it, you hope oil prices go up, and you collect a dividend. That's the simple story. But the reality of this particular fund is far more complex and, frankly, far more aggressive. What most retail investors, whether they're using Robinhood for a quick trade or building a long-term plan with Fidelity Investments, fail to see is that DRLL isn't just a passive fund, it's an active weapon. This ETF is the flagship product of Strive Asset Management, and its entire stated purpose is not just to hold energy stocks, but to use its shareholder power, its proxy votes, to force these companies to change. The expectation is a simple energy play. The reality is an activist campaign packaged as an ETF, one that explicitly rejects environmental, social, and governance criteria, and instead demands one thing: drill, produce, and maximize profit, period. This is the central tension of this investment. The market narrative for the last several years has been that energy companies must balance production with a transition to greener alternatives. We've seen massive institutional pressure from giants like BlackRock and State Street pushing ESG-friendly board members and climate resolutions. This created a generation of investors who believe the path for energy is one of apology and managed decline. Strive, and by extension DRLL, represents the absolute opposite. It's a contrarian bet that says the ESG movement has actually hamstrung these companies, forcing them to underinvest in their core business, which has in turn contributed to higher energy prices and market instability. The DRLL thesis is that by actively voting against climate-related shareholder proposals and for proposals that incentivize more exploration and production, they can help these energy giants return to their primary mandate and, in doing so, deliver better returns. This is a radical departure from the set-it-and-forget-it mentality of most ETF investing, and it's a concept that many investors on platforms like SoFi Invest or those using a Schwab Intelligent Portfolios robot advisor might be completely unaware of. They might just see a fund with a 0.41% expense ratio that holds big oil. They might not realize they are, by proxy, participating in a significant corporate governance battle. So let's look at the recent trading action in that context. The fund's movement this past week, where it largely tracked the underlying moves in crude oil and its main holdings, is the expectation part of the equation. Exxon and Chevron make up a massive part of this fund, together accounting for over 45% of its assets. When they move, DRLL moves. It's that simple. This past quarter, we saw earnings from these giants that were, by and large, strong. They beat expectations on profit, largely thanks to resilient refining margins and cost controls, even as oil prices pulled back from their highs. This fed the narrative that these companies are cash flow machines. But the DRLL story is what happens next. The fund's managers are not just passively collecting those dividends, they are actively engaging with the management of these companies. Their stance is that as impressive as the buybacks and dividends are, they could be even better if these firms weren't, in Strive's view, diverting billions in capital to low-return green projects solely to appease ESG-focused asset managers. This is the core challenge. The market is trying to price in two completely different futures, one where big oil transitions into big energy, and one where big oil just gets bigger and better at being big oil. DRLL is a bet, and a big one, on the latter. This active, vocal stance is what separates it from a competitor like XLE, the main energy select sector spider. Many investors might just compare the expense ratios and top holdings on their Fidelity brokerage account and miss this critical difference entirely. The trading volume on DRLL has been a point of interest. While it's not as liquid as its gargantuan competitor XLE, it maintains significant assets under management, well over $200 million. This indicates a dedicated core of believers. But we've also seen significant outflows over the past year. This tells us the story is polarizing. As the initial hype of its 2022 launch has faded, investors are now having to decide if the activist-in-a-box model is actually working or if it's just a marketing gimmick on top of a standard energy fund. The reality is that it is incredibly difficult to quantify the Strive effect. Can a sub-billion-dollar fund really change the direction of a multi-trillion-dollar company like ExxonMobil? The expectation is, yes, that's what I'm paying for. The reality is, maybe, but it's an uphill fight. The real value might not be in a single changed vote, but in providing a high-profile anti-ESG counter-narrative that gives cover to company management who already want to focus on fossil fuel production, but felt pressured by other institutions. It's a psychological play as much as a financial one. Traders using more sophisticated platforms like interactive brokers might be looking at fund flow data and seeing this tension, trying to gauge if the true believers are sticking around or if the hot topic crowd has moved on. The performance, since inception, has been decent, but it has largely just tracked the energy sector. It hasn't significantly outperformed its peers, which challenges the idea that its active stewardship model is generating alpha. Let's break down what this fund actually is. The Strive U.S. Energy ETF, DRLL, is an exchange-traded fund. You can buy and sell it just like a stock on any online investment platform from Robinhood to Fidelity. It aims to track the Solactive United States Energy Regulated Capped Index. Its holdings are a who's who of American energy. As mentioned, Exxon and Chevron are the two titans, making up a colossal chunk of the portfolio. After that, you get names like Valero Energy, Marathon Petroleum, Phillips 66, ConocoPhillips, and EOG Resources. It's a concentrated bet on the largest integrated oil and gas companies, refiners, and producers in the U.S. The fund was launched in 2022, right into a perfect storm of high energy prices, post-pandemic demand, and geopolitical instability. Its founding philosophy was and remains that the U.S. energy sector is the key to American prosperity and security, and that it has been shackled by a political and financial consensus that wants to put it out of business. Investing in DRLL, you are, in effect, signing on to this worldview. This is not your grandfather's passive index fund. It's a fund with a very loud, very clear political and economic ideology. This is a crucial point for anyone doing self-investing. You're not just buying a collection of stocks, you're buying a mission statement. And that mission is to depoliticize corporate America by using its own political style pressure. The irony is thick, but the financial thesis is clear. Looking at the broader macroeconomic picture, the outlook for DRLL is tied directly to the price of oil and gas, but also to the regulatory environment. We're in a high interest rate environment, which has put pressure on all capital-intensive industries. The expectation was that higher rates would crush demand and with it, energy prices. The reality has been more complex. Geopolitical flare-ups, tight supply from OPEC+, and resilient consumer demand have kept a floor under prices, allowing these companies to remain incredibly profitable. The Fidelity mutual funds and Fidelity ETFs that are overweight in energy have benefited from this. But the risk for DRLL is twofold. First, a genuine global recession would eventually destroy demand and send prices tumbling, taking DRLL with it. No amount of shareholder activism can fix a global glut of oil. Second, the political winds. The very ESG-focused policies that Strive opposes could gain new momentum, leading to windfall profit taxes or stricter drilling regulations. This is the tightrope DRLL is walking. Its own thesis is that these companies should ignore political trends and just produce. But those same political trends could kneecap their ability to do so. This is why following this fund requires more than just checking commodity prices. It requires a keen understanding of the political battles being fought in Washington and in corporate boardrooms. I'm curious what all of you think about this. Comment below. Do you believe the anti-ESG shareholder activism from funds like DRLL can actually force a change in big oil, or is it just a marketing tool? Looking ahead, what are the catalysts and risks? The biggest catalyst for DRLL would be a sustained period of high energy prices combined with a clear win from its activist arm. Imagine if ExxonMobil's CEO, in an earnings call, explicitly stated they were increasing their exploration budget at the encouragement of shareholders like Strive.